Hi, welcome to Let's Talk Bonds, the bond market podcast from INR Bonds, and I'm Anshul Patsarthi. And today we are going to discuss the talking point of financial markets in India and maybe across the world itself, given that India is becoming one of the key markets for the global economy too. This is the spread between the US Treasury, the 10-year US Treasury, and the 10-year GSec has is down to record lows, levels never seen before. Currently, the US 10-year Treasury yield is at around 4.5%. The 10-year Indian government bond yield is at 6.2%. The spread is around 170 basis points or 180, just over 200, around below 200 basis points. Now, given this record low spreads, what does it mean for financial markets? What does it mean for the bond market in India? What does it mean for bond investors in India? And why is the spread coming down? Is it because of Indian yields coming down? Is it because of US yields going up? Or is it both factors? I will take you through all this in this podcast, and hopefully, investors listening and those listening to the podcast today will have a better fix of what to do with their bond portfolios after this podcast. And today I'm joined by Sambit, our young research analyst, credit research analyst from Capital Gate research analyst firm. And he will take you through the basic metrics of the US fiscal and the bond, US Treasury holding metrics and others. And that partly can explain why the yields are moving up on the US side. Now, let's start with the U.S. Treasury moving up. But before that, um, uh, investors should be aware that bond markets do carry interest rate risk, credit risk, and liquidity risk. And they may be lose capital through price depreciation or default or impact cost of buying and selling. Now, why are the U.S. Treasury yields moving up? Sambat, can you just take us through the basics of U.S. Debt?
Yeah, hello. So US, the current US debt, fiscal debt, stands at a record USD 36 trillion. It is up from 28 trillion as of 2020. So about a 25-30% jump in the last 5 years. Also, the fiscal cap is expected to be $1.9 trillion with a debt to GDP of 120% on the higher side for a developed nation. And also the UST and GSec spreads have narrowed to about 21-year lows to about 170 basis points. Right. Coming to foreign holdings of US treasuries, Japan still leads the way, with China coming down from the second biggest holder to the third biggest holder. It has sold about $20 billion of USD in the last couple of months, currently standing at 765 billion US dollars as of March 2025.
Right. And the U.S. fiscal debt to GDP's ratio is 120%. Would that be right?
Yes.
Okay. Now, coming to so basically, what are we saying here is that given that the U.S. has been expanding its government debt. Clearly, it's running a large fiscal deficit. Every year, close to $2 trillion is being added to the US fiscal gap, US and total debt outstanding for the US government. And US is also running a trade deficit. That means it is it's a net importer of foreign goods. And because it is a net importer, what it happens is exporters, the net exporting countries like China and Japan run up very large trade surpluses, and they have been using the trade surpluses to invest in US treasuries. Now, with all this talk of trade, tariff wars, and many other aspects, and also that the debt has been expanding like this, so the general feeling in the markets is that foreign investors are not going to be investing and supporting the US fiscal gap. And so US has to look at funding its fiscal gap through its own domestic markets, that is through the savings of its households. And to a very large extent, the general data is that the US households are net savers, not savers. So basically, a consumption-driven economy led by debt. Now, taking India for example, India's household savings is net. India is a net savings country, where household savings are very heavily positive, and we are still not have not gone even very close to a consumption-driven economy, the way the US has gone. So the different. So when the U.S. government finds that there are no takers for its bonds by foreign investors, and it has to go to the local market, and the local investors do not have the savings to finance the government debt, then it's becoming a serious problem. Then who has to finance the government debt? It has to be the Fed. Now the Fed can technically finance the government debt. It does run a very large balance sheet, and which has been expanded and to various during various times. For example, 2008 financial crisis, it went into a quantitative easing program. Then the COVID times, it went into QE. But what it also seen is that, especially after the COVID, when the Fed went into a very large QE, the inflation shot up. So US is in a very precarious position where if the Fed is the one that is going to support the US government debt, then the inflation pressures can shoot up, and that would mean long term bond yields rise. So if you look at the 10-year US Treasury, while it's still at 4.5%, the US 30-year Treasury is at over 5.1%. Now, the 30-year Treasury is a benchmark for US mortgages, the mortgage index, and where the US households can borrow to invest in real estate. Now, and these are long-term mortgages, and mortgage costs going up. That means what will happen is there'll be less demand for real estate. Current prices of real estate can come down unless foreign buyers come to invest in US real estate, which they may or may not do so. But even if they do, they'll come and buy at much lower prices than what it is now. And all this put together can lead to a very strong downtrend in the US economy. Now, if there is definitely a downtrend in the US economy, which will impact the global economy as well, then all over the world, anybody exporting to the US, any country that is exporting services and goods to the US will also find that its economy is also slowing down. So it can lead to a worldwide economic degrowth. Uh, so there is definitely a knock-on effect of this. Now, coming back to India, so why are the Indian GSec yields have come down very sharply? The last 1 year, it's come down from over 7% to 6.2% in the 10-year. RBI has cut rates by 25 basis points twice in the last this year, and is expected to cut rates by another 25 basis points in this monetary policy in June. And that's largely because of three or four factors. One is that the RBI does see that inflation is reasonably contained here. There could be knock-on effects of global slowdown in the Indian economy. There is definitely some kind of a consumption slowdown, as seen by various earnings calls coming in, earnings seasons coming in this quarter, for the first quarter, for the fourth quarter of last year, and the guidance for this coming year. There is definitely a bit of caution across all the corporates that are coming out with earnings season. And even if the export sector gets hurt because of US slowdown, all that will definitely impact growth in the country. And RBI deems it fit that it needs to one is lower the repo rates, and accordingly, 10-year GSec yield also come down. And to one part of it, the yields coming down so sharply is because RBI has sucked out a lot of supply from the market through purchase of government bonds in this year. They have bought over 5 lakh crores of government bonds. Now that's a very large purchase. So that has taken that supply off, And so there is enough demand in the system with rate cuts and all that, with GSec yields coming down. But what can happen going forward? Clearly, two things. One is that if this trend continues and if there is a recession in the US and leading to a global downturn in economic growth, India too will feel the effects, and that could impact financial markets, which are dependent on the growth. It could also impact government bond yields. At the same time, there could also be some kind of that RBI could ease rates substantially. Yields can come down substantially, and the sort of bonds could get more attractive. And if bonds with reasonably good credit, and there could be a lot more put thrust towards domestic consumption. That means domestic lending, domestic borrowing, etc. And all these. So you could have bond yields across the curve that could see a positive impact. And also that the fact that we have seen the foreign exchange reserves of India going up from $650 billion to close to $700 billion, and it had gone down from $700 billion to $650 billion. There's a lot of volatility in the currency markets as well. And with this volatility in the currency markets, then the RBI may want to shore up the dollar purchase, the foreign exchange reserves, not knowing when capital flows could go back to the US, higher yielding US treasuries, if that happens at all. This is and so RBI may want to just about be prepared for that and may shore up FX reserves. And when they do that, they're going to add in liquidity into the system. So a lot of money is going to be there in the system at this point of time. Now, on a longer term basis, what would money capital flow out of Indian rupee into US dollar? Capital shift into higher yielding U.S. Treasuries. Mr. Uday Kotak had mentioned in a recent statement that this is a very unprecedented market where the spread between UST and GSec are at record lows. There could be capital outflows as money goes into potentially uh, safer U.S. treasuries. But the question mark here, I would say, is that are U.S. treasuries safe? Given the fact that I just explained that why U.S. treasuries could be unsafe, especially at the longer end of the curve, if Fed starts to buy and inflation rises up, and all that other around that, because U.S. Savings, domestic savers do not have the potential to support the U.S. government borrowing. So all this can have an effect. Very premature to say what can happen. But the current trend is that the markets are moving towards a belief that definitely U.S. borrowing program could be a problem for the U.S. That's why they're taking up the long-term yields. And in India, RBI was very sure that higher U.S. yields can lead to degrowth in the U.S. economy, which can have a knock-on effect of India, and they need to boost local consumption, and they would cut rates, and government bond yields and corporate bond yields can come off sharply. That is the basic crux at this point of time. Like I said, it's too premature to envisage a longer term scenario of whether potentially there's even talk of 30-year US Treasury yield going to 7%. Now, maybe those are all very pessimistic cases, typically, and commentators across the globe are worried about this particular phenomenon of U.S. Treasury yields rising. And all this, if it comes through, then you are going to have a volatile market. And so having said that, in India, what we are definitely seeing is one is that RBI is going to be more accommodative. Rate cuts are going to happen. They're going to shore up on foreign exchange reserves, and they will do their part in boosting domestic consumption. That's all there is to it in this Let's Talk Bonds podcast. And do hope that all of you, after this podcast, will have a general better view on how to position the bond portfolios. And do reach out to INR Bonds for any of your bond requirements. We are an SEBI NSE debt broker and OBPP platform. We are a SEBI registered stockbroker, and all our transaction takes place through the NSE settlement system. Thank you for listening in.